So if a doctor looks at a broken arm on an X-ray, it's totally binary.
Oh, absolutely. The bone is either fractured or it isn't.
Exactly. The diagnosis is immediate. It's visual. You can't really argue with it. But today, for this deep dive, we are looking at the financial X-ray of a massive global industrial giant.
Right. We're talking about the Q2 2026 earnings call for Ingersoll Rand, ticker symbol IR.
And like I say, the diagnostic image here is incredibly murky. I mean, we are dealing with a company that operates across dozens of countries. They manage hundreds of product lines.
Yeah, and they're navigating completely bifurcated economic realities. I mean, the Americas, Europe, China, they're all telling totally different stories right now.
Which is exactly why our mission for this deep dive is to cut through all the corporate jargon of this earnings call and extract the pure, actionable intelligence for you.
Because it is the absolute definition of diagnostic muddy waters.
Right.
When you step out of the clean, high-margin world of software and into the gritty, capital-intensive reality of global industrial manufacturing, a single headline number rarely tells the whole story.
Oh, for sure. You've got localized inflation. You've got severe regional overcapacity.
And project cycles that stretch out for literally years.
Yeah. But Ingersoll Rand is one of those foundational companies that most people just kind of ignore, yet their equipment literally keeps the modern world functioning.
They make the mission-critical stuff: air compressors, blowers, precision vacuum systems.
Right. So we are going to figure out how this supposedly boring manufacturer is quietly managing a massive margin squeeze in Asia while dealing with delayed mega projects in Europe.
And somehow, simultaneously, they are positioning themselves as a critical linchpin in the explosive AI data center boom.
It's wild. But to understand the future trajectory of their AI and biopharma plays, we have to first ground ourselves in the immediate reality of their execution today.
Yeah, Vicente Renaud, the CEO, and Vic Kinney, the CFO, they presented a Q2 snapshot that demands a really close reading. So let's get into the headline numbers.
Let's do it. So starting with the top line data that crossed the wire, they reported organic order growth of 2% and organic revenue growth of 4%.
Right.
And just to filter out the noise for you, if you're tracking the broader market, that organic metric means their core business is expanding strictly on its own merits.
Exactly. It strips out the revenue they basically bought through their various acquisitions.
Yeah, and it removes the illusion of growth or contraction, honestly caused by foreign currency swings.
Which is crucial. And in the context of the 2026 macroeconomic environment, I mean, that 4% organic revenue growth is a statement of extreme resilience.
You think so?
I do. Look, the global industrial market is wildly mixed right now. You have stubbornly high interest rates dampening capital expenditures everywhere.
Right, plus all the geopolitical tensions disrupting supply chains.
Exactly. And a completely uneven recovery cycle, depending on which continent you're actually looking at.
Okay, but wait. Let me push back on that idea of extreme resilience for a second, because I'm looking at a tech-heavy market where companies are posting 30, maybe 40% growth year over year.
Sure.
So I see a 2% organic order growth number for an industrial manufacturer, and honestly, it sounds a bit sluggish.
I get that.
It sounds borderline stagnant. I mean, why should an everyday retail investor get excited about a company growing at a 2% clip?
Because top-line growth is vanity, but cash is reality. You really have to look at the financial engine operating underneath that 2% order growth.
Okay, break that down for me.
In this single quarter, despite the sluggish top-line environment you just mentioned, Ingersoll Rand generated a staggering $269 million in free cash flow.
Oh, wow.
Yeah, that is a 28% increase year over year.
Wait, a 28% jump in free cash flow on just 4% revenue growth?
Exactly.
That implies a massive amount of operational leverage.
It's huge.
Yeah.
They're squeezing significantly more actual spendable dollars out of every marginal unit they sell. They're essentially operating a masterclass in cash conversion right now.
Right. Vicente Renaud even noted their free cash flow conversion is currently expected to remain at approximately 95% for the year.
Which is an insane metric. Let's actually unpack the mechanics of that 95% conversion, because that is a metric that separates the truly well-run businesses from the capital incinerators.
Yeah, because when a company reports net income on their income statement, that's really just an accounting figure.
Honestly, exactly. It includes depreciation, amortization, various non-cash adjustments. It's not necessarily money in the bank.
But a high cash conversion rate means that for every dollar of that accounting profit, 95 cents is instantly materializing as cold, hard cash in their bank accounts.
Yes. They are not letting their capital get trapped in bloated inventory sitting in some dusty warehouse.
Right.
And they're not letting receivables age out because customers aren't paying them. Their working capital management is hyper efficient.
They are basically a freight train. Like, it's not about hyper growth. It's about compounding value through just relentless execution.
That's the perfect way to put it. They take a modest top-line expansion, run it through this incredibly disciplined manufacturing and supply chain process, and spit out a mountain of cash on the other side.
And that cash generation has built them a phenomenal war chest. I mean, they ended Q2 with $3.8 billion in total available liquidity.
Right, which includes about $1.2 billion in actual cash on hand, plus massive capacity on their credit facilities.
Meanwhile, their leverage ratio, which is their total debt relative to their earnings, that remained at a highly conservative 1.7 times.
They are completely underlevered, especially in an environment where debt is still really expensive.
Which is the exact profile of a defensive compounder. I mean, in a choppy economic sea, you want a ship with a pristine balance sheet that throws off cash regardless of whether the broader economy is booming or just sort of bumping along.
Absolutely.
But I want to look closely at another piece of their top-line data before we dive into all the regional drama.
Okay, what's that?
Total orders finished just over the $2 billion mark, which is up 5% overall. But their book-to-bill ratio finished at exactly 1.0x.
Right, the 1.0 ratio.
Yeah, and for you listening, a 1.0 ratio means perfect equilibrium. For every dollar of equipment they shipped and billed, they took in exactly $1 in new orders.
It is perfect equilibrium on paper. But CFO Vic Kinney was actually very quick to qualify that number on the call.
He was, yeah.
He pointed out that 1.0 is actually slightly lower than the ratio they typically see in the second quarter.
So did he sound the alarm on that? Because, if you're burning through your backlog faster than you can replace it, that usually signals a pretty nasty demand cliff approaching in the next few quarters.
Well, he didn't sound the alarm, no, but he did provide a critical mechanical explanation. He stated the lower ratio primarily reflected the delayed timing of several large, highly complex project orders.
Ah, okay. So we have a company generating massive cash, but facing sluggish top-line orders due to project delays. To truly understand why this is happening, we have to pull the business apart. Ingersoll Rand divides its empire into two distinct reporting segments.
Right. The first and largest being ITS, which is Industrial Technologies and Services.
So what did the X-ray show for the ITS segment this quarter?
Well, the ITS segment presented a very complex, honestly kind of conflicting picture. On the positive side, overall revenue increased nearly 9% year over year.
And 4% organically, right?
Yep. And the Americas region was the absolute powerhouse driving this. Vicente noted that organic orders in the Americas for ITS were up high single digits.
High single digits in the Americas. I mean, that is a massive signal about the health of the U.S. industrial economy.
It really is. And the analysts on the call dug into this. This wasn't just a blip driven by one lucky contract. The demand was remarkably broad-based.
Yeah, they saw strength in power generation infrastructure, air separation systems required for semiconductor manufacturing.
Which is a huge growth area right now.
Totally. And across general industrial food and beverage applications.
The American industrial machine, at least judging by their order book for core compressor technologies, is running incredibly hot.
But there is a glaring contradiction in this ITS data.
The margin squeeze.
Yeah, the margin squeeze. While the revenue in the Americas was surging, the actual profitability of the entire ITS segment took a pretty nasty hit.
It did. Their adjusted EBITDA margin contracted by 160 basis points year over year, dropping to 26.8%.
And in the fiercely protected world of industrial margins, a 1.6% contraction is painful. What mechanically drove that?
So Vic Kinney laid out three very specific catalysts for this margin degradation. The first, and perhaps most structurally significant one, is severe inflationary pressure combined with a total loss of pricing power in China.
Let's unpack the macroeconomic mechanics of that. I mean, why does an American industrial giant suddenly lose its ability to price its goods in China?
It basically comes down to structural overcapacity in the Chinese domestic market. Over the last several years, Chinese domestic manufacturers have built out massive production capabilities. They scaled up factory capacity, assuming exponential, unending domestic growth.
Which didn't happen.
Exactly. With the Chinese property sector stalling and their broader economy really slowing down, All those factories are now totally starved for demand.
So you basically have too many factories chasing way too few industrial projects.
Precisely. And when a domestic Chinese factory is faced with either, shutting down its assembly line, which incurs massive localized political and labor costs, or selling equipment at a loss just to keep the lights on and the workers employed.
They choose to slash prices.
Yes. They engage in a race to the bottom.
Which means Ingersoll Rand is sitting there with these premium, highly engineered compressors. They're facing raw material inflation, but if they try to raise their prices to protect their margin, the Chinese customer just pivots to the heavily subsidized, hyper-cheap, local alternative.
Yep. The pricing environment, as Visset politely described it to Wall Street, is quote-unquote challenged.
Challenge, that's a good corporate euphemism. But this raises a fundamental strategic question. An analyst on the call essentially asked Vicente, if the pricing power is so uniquely terrible in China right now, why even stay in the fight?
It's a fair question.
Right. Why should a premium company take a margin hit just to win a race to the bottom? Shouldn't they just pack up their toys, protect their overall corporate margin profile, and focus all their energy on the booming Americas market?
Well, if a CEO is managing strictly to appease short-term Wall Street algorithms, yeah, they exit the market. But if they are managing for the next 2 decades, they stay.
Right.
Vicente offered a really fierce defense of their strategy, which they call in China for China.
I want to explore the underlying math of that strategy, because selling complex machinery at a low margin today doesn't sound like a winning long-term formula unless there is a massive hidden hook.
Oh, there is. The hidden hook is the aftermarket. In heavy industrial manufacturing, the initial sale of a giant air compressor or a specialized vacuum system, the original equipment, or OE, is just the tip of the iceberg.
Because OE sales are intensely competitive and traditionally carry much lower margins anyway, right?
Exactly. The real wealth is generated in the aftermarket.
It's the classic subsidized console model.
Yes, exactly.
Like you sell the video game console at a break-even price or even a slight loss just to secure a permanent place in the customer's living room. And then you spend the next 10 years selling them high-margin software subscriptions and extra controllers.
That is the exact mechanism. For Ingersoll Rand, the software is the replacement parts, the specialized maintenance contracts, and the proprietary servicing required to keep a mission-critical compressor running continuously for 15 to 20 years.
So Vicente is essentially saying that they are aggressively localizing their new technologies for the Chinese market right now.
Yes. They are winning bids for original equipment in novel applications. They're securing footholds with customers they have literally never reached before.
And yeah, the margin on that initial installation today is ugly because of the localized price war. But every single machine they bolt to a factory floor in China today represents an unbraidable, high-margin annuity stream of service revenue for tomorrow.
Exactly. If they pull out of China to protect their Q2 2026 margin, they permanently forfeit the aftermarket of the world's second-largest economy for the entirety of the 2030s.
Wow. Put that way, it makes total sense.
Right. By absorbing the margin pain today, they're planting the seeds for incredibly lucrative service revenue years down the line, when the Chinese overcapacity cycle inevitably corrects itself and the weaker domestic players consolidate.
It really is a masterclass in strategic patience, but China wasn't the only drag on the ITS margin, was it?
No, it wasn't. The second factor Kinney mentioned was continued commercial investment. They are actively deploying capital into sales forces and engineering teams to support future growth around new technology and digital applications.
Planting more seeds. I can accept that. But the third reason for the margin drop in HES was purely financial and, frankly, a bit annoying for an investor to read.
The incentive tree up.
Yeah. Kinney pointed to higher corporate costs, driven largely by a year-to-date true-up of management incentive costs. I mean, unallocated corporate costs were $49 million in the quarter, up massively from $34.6 million a year ago.
It sounds like a Wall Street euphemism for we wrote ourselves bigger bonus checks, doesn't it?
It really does. But let's contextualize this mechanically, because I want you listening to really picture this. Imagine you are diligently managing your household budget, and suddenly you get hit with a massive, unexpected adjustment on your utility bill.
Ouch.
Right. Because the electric company realized they had been undercharging you for the previous 6 months based on faulty estimates. It destroys your monthly budget for July. The optics are terrible.
But it is a one-off accounting event.
Exactly. It merely brings the ledger back into balance. It does not mean your permanent structural electricity rate has structurally doubled.
And that is the precise accounting mechanism at play here. The incentive compensation adjustments were triggered by the company's strong underlying performance relative to their internal targets over the longer term.
Which is a good thing.
Right. But due to strict accounting recognition rules, a disproportionately large chunk of that expense had to be recognized immediately in Q2.
And both Vicente and Vic were adamant on the call that they do not expect this elevated level of corporate costs to recur in the back half of the year.
They paid the surprise utility bill. The ledger is clean moving forward.
Okay, so that encapsulates the ITS segment robust volume in the Americas, deliberate margin sacrifices in China for long-term aftermarket gain, and a transient accounting true-up. Let's pivot to the second reporting segment, PST, which stands for Precision and Science Technologies.
Oh, this is the fun part.
Yeah, because if ITI was dealing with muddy waters, the PST segment operated like an absolute star player this quarter.
PFT was exceptional across the board. Orders in this segment surged by 11% overall and 7% on an organic basis.
And the core engine driving this massive outperformance was their life sciences division, right? They delivered low double-digit organic order growth.
Yeah.
But I need to pause here because the juxtaposition is so jarring to me. When I think of industrial equipment, I picture steel pipes, oily machine shop floors, heavy manufacturing.
Sure.
What business does a rugged industrial company have operating inside the pristine, hyper-sterile environment of life sciences and pharmaceuticals?
They are providing the hyper-precise fluid handling equipment required to physically manufacture modern medicines.
Wow.
During the Q&A portion of the call, an analyst from Baird, Rob Wertheimer, specifically honed in on this momentum. Vicente Reynaud explained their deep exposure to the biopharma space, and he specifically called out their involvement in the GLP-1 market.
Okay, GLP-1. For those tracking the pharma space, we are talking about the blockbuster weight loss and diabetes therapeutics, things like Ozempic, Wegovy, and Mounjaro.
Yep.
This isn't just a growing market, it is arguably the single most explosive pharmaceutical trend of the 21st century.
It's an absolute gold rush. But manufacturing biologic drugs at a global scale is incredibly complex from an engineering standpoint.
Oh, I bet.
These aren't simple chemical pills you just press in a machine. They are complex proteins and peptides.
Let's drill into the fluid dynamics of this. To manufacture a biologic like a GLP-1 agonist, you are dealing with living cells, fermentation processes, and highly viscous fluids.
And the dosing has to be microscopically precise. Furthermore, the entire fluid pathway must remain absolutely sterile.
Right, so you can't just use a standard industrial pump with a mechanical seal, right? Because the friction would destroy the delicate proteins.
Exactly. Or bacteria would inevitably breach the seal and literally ruin a multi-million-dollar batch of medicine.
That's insane.
That is precisely where Ingersoll Rand's PST segment dominates. They manufacture specialized peristaltic pumps and highly engineered dosing systems that move these delicate fluids without ever exposing them to mechanical contamination or shear stress.
So they are quite literally selling the picks and shovels to the GLP-1 gold rush. They don't have to take the clinical trial risk of developing the drug. They just supply the critical infrastructure required for the pharmaceutical giants to scale their production.
And Vicente noted, they're not just riding the current wave of existing capacity. They are aggressively making commercial investments to ensure their equipment is designed into the blueprints of the massive new biopharma facilities being constructed right now.
For production in 2027 and 2028.
Exactly.
And the financial profile of this PST segment is wildly different from the heavy industrial side. Unlike IPS, which saw margins contract, the PST segment demonstrated immense operational leverage.
Huge. They expanded their adjusted EBITDA margins by a massive 200 basis points, a full 2% landing at an incredible 31.5%.
A 31.5% profit margin is software company territory. That is almost unheard of in traditional manufacturing.
It really is.
How are they commanding that kind of pricing premium?
It speaks entirely to the mission-critical nature of precision fluid technologies. Think about it. When a pharmaceutical company is processing a batch of biologics worth tens of millions of dollars, they are not going to bargain hunt for a cheap, generic pump.
Right. The cost of pump failure is catastrophic.
Exactly. They willingly pay a massive premium for the absolute highest quality, most reliable equipment on Earth, because the pump is quite literally vital to the integrity of their product.
Speaking of vital equipment, Vicente shared an anecdote on the call that perfectly illustrates the real-world life-or-death application of this PST technology. It strips away all the financial jargon and grounds the business in human reality.
Oh, the Philippines story.
Yeah, he talked about a massive earthquake that recently struck the Philippines.
Right. In the aftermath of a catastrophic natural disaster like that, localized infrastructure is completely decimated. The power grid goes down, water treatment facilities are destroyed.
And the most immediate critical threat to human life isn't necessarily the rubble, it's waterborne illness from a lack of safe drinking water.
And Vicente noted that Ingersoll Rand didn't just, issue a corporate press release or write a charitable check. Their equipment was physically deployed on the ground, actively saving lives.
Because they partner closely with the Planet Water Foundation, an organization that deploys safe drinking water stations across disaster zones.
Yeah, these stations are known as aqua block kiosks.
Let's look at the mechanics of an aqua block. In a disaster zone, you don't have electricity. You can't plug in a massive filtration system.
Right, the grid is down.
You have to draw contaminated water from a river or a flooded well, purify it, and dose it with exactly the right amount of chlorine or coagulant to make it safe for human consumption, all without external power.
And the heart of that entire aqua block kiosk, the mechanical engine that makes the purification process possible, is an Ingersoll Rand Dosatron pump.
The mechanics of a Dosatron pump are fascinating. I mean, it doesn't use electricity. It is installed directly into the water line, and it uses the kinetic energy of the water pressure itself as its only power source.
It's brilliant. As the water flows through, it drives a piston that acts as a volumetric dosing mechanism.
Injecting a hyper-precise ratio of purifying chemicals into the water stream, regardless of fluctuations in flow rate or pressure.
It's brilliant engineering, and it perfectly proves Vicente's overarching thesis about the mission-critical nature of their portfolio. We spent our time analyzing spreadsheets, EBITDA margins, organic growth rates, but at the foundational level, these are physical technologies solving critical constraints.
Right. A volumetric dosing pump sounds like an incredibly dry piece of industrial trivia until it is the only mechanical device standing between an earthquake-ravaged community and a cholera outbreak.
That is a profound perspective shift, for sure.
It really is. Okay, so we have dissected the two segments, ITS and PST. But the geographic story in this earnings call is just as complex as the segment divide.
Yeah, we already talked about the powerhouse Americas region and the margin-crushing overcapacity in China.
But there is a third continent that requires deep analysis. EMEA, Europe, the Middle East, and Africa.
EMEA accounts for roughly 1/3 of Ingersoll Rand's total revenue, so it is a massive piece of the pie. And the headline number out of EMEA was ugly. Orders in the region were down low double digits organically.
A double-digit drop in orders across a third of your business is usually the hallmark of an industrial recession. If you see that number in isolation, your immediate assumption is that European demand has basically evaporated entirely.
Sure. But Vicente was hyper-focused on contextualizing that drop to prevent a Wall Street panic. He explicitly clarified that this double-digit contraction is a timing issue, not a demand destruction issue.
Let's explore the mechanics of that. I mean, how does a company lose double-digit growth simply because of the calendar?
It comes down to the fundamental nature of their long-cycle project business in that specific region. In Europe and the Middle East, Ingersoll Rand has a massive business selling highly customized, multi-million-dollar blower and vacuum systems for complex infrastructure projects.
Like massive wastewater treatment plant upgrades or massive petrochemical facility expansions.
Exactly. These are not off-the-shelf compressors you just order out of a catalog. These are engineered-to-order behemoths that require months of technical design, rigorous environmental permitting, and extremely complex financing structures.
Right. And Vicente noted that several of these massive long-cycle projects simply got delayed in the procurement pipeline.
The customers did not cancel the projects. The underlying demand for the infrastructure upgrade still exists, but the final signatures were just pushed out of the second quarter.
He specifically mentioned that project activity in the Middle East remains severely delayed. To prove that the underlying European economy wasn't collapsing, he pointed to a totally different metric.
Right, he isolated their core, shorter cycle compressor orders in EMEA. These are the day-to-day standard industrial machines.
And those orders were actually up low single digits organically, right?
Yes. So the bread and butter transactional business in Europe is still growing steadily. It is just the massive, complex, mega projects that are stuck in the mud of corporate bureaucracy or financing delays.
Which brings us perfectly to the third phase of our deep dive, management guidance. Because if you aggregate everything we have just discussed, a brutal margin squeeze in China, a massive accounting true-up hurting the ITS segment, and double-digit mega project delays in Europe, you would naturally assume that management is preparing to lower expectations.
Oh, absolutely. You'd expect them to get conservative, lower their revenue targets, and brace for a difficult second half of the year.
But they did the exact opposite.
They really did.
They looked at that incredibly complex, headwind-filled landscape, and they confidently raised their full-year revenue guidance.
It was a massive flex of operational confidence.
Yeah.
I mean, they previously guided for a certain level of organic revenue growth, and on this call, they upgraded their projection to total revenue growth of 4.5% to 6.5%.
That represents a 200 basis point bump at the midpoint of their range. They are essentially telling the market, yes, we had some friction in Q2, but the back half of 2026 is going to accelerate violently.
Yeah.
And what about their profitability? Did they raise the bottom line expectations as well?
They did. While they maintained their overall adjusted EBITDA dollar range of $2.13 billion to $2.19 billion, they gave a very aggressive signal on their earnings per share.
Oh.
They stated unequivocally that they expect adjusted EPS to land near the absolute high end of their previously committed range of $3.45 to $3.57.
So they are projecting accelerating revenue and top-tier profitability. How are they justifying this? I mean, earnings calls are traditionally backward-looking. They are an autopsy of April, May, and June.
Usually, yes. But Vicente dropped a forward-looking plot twist regarding the current month of July that completely changes the narrative.
Okay, here's where it gets really interesting. Let's hear it.
He prefaced it by noting that management generally hates giving intra-quarter updates, but the data was just too compelling to hide. He announced that Ingersoll Rand experienced a great start to July, specifically seeing double-digit order growth through the first 4 weeks of the month.
Let that sink in for a second. We spent the first half of this deep dive analyzing a sluggish 2% organic order growth rate for the entire second quarter. And suddenly, in the very first month of Q3, they're posting double-digit order growth.
Yeah.
That is not a gradual recovery. That is a violent vertical acceleration. What mechanical catalyst triggered that? Did the global economy suddenly boom on July 1st?
Not at all. The catalyst was the unblocking of the very delays we just discussed.
Okay.
Remember those long-cycle mega projects in EMEA and the Middle East that were stuck in the mud in Q2?
The ones that dragged down the European numbers?
Exactly. In July, the mud dried up, the bureaucratic bottlenecks cleared. Vicente explained that they saw strong, immediate realization of several massive long-cycle orders that had been artificially delayed in the first half of the year.
The customers finally secured the financing, signed the paperwork, and released the capital expenditures.
Yes.
But why the sudden massive release? I mean, what forced the hands of these plant managers and infrastructure developers to finally pull the trigger all at once in July?
Several analysts, including Jeff Sprague from Vertical Research, zeroed in on this exact question. They wanted to know the common mechanical thread unlocking these dormant projects.
Right. And what was the thread?
Vicente pointed directly to the most powerful economic forcing function in the industrial world right now: energy efficiency.
Okay, let's explore the thermodynamics and economics of this because it is fascinating. Vicente dropped a statistic on the call that sounds almost fabricated until you actually do the math.
It's crazy.
He noted that compressed air typically accounts for 30% of the industrial electricity consumption in a manufacturing facility.
30%. Think about the sheer scale of a modern manufacturing plant. The lighting, the conveyor belts, the massive robotic assembly arms, the massive HVAC systems.
Yet nearly a third of their entire utility bill is generated just by the motors spinning to compress air. Why is compressed air so wildly energy intensive?
It's because of the physics of compression. When you force a gas into a smaller volume, the kinetic energy of the molecules increases rapidly, which generates massive amounts of heat. In a standard industrial air compressor, a huge percentage of the electrical energy consumed by the motor isn't actually used to move the air. It is wasted as heat loss. It is an inherently inefficient thermodynamic process.
Which means an older legacy air compressor that has been running on a factory floor for 15 years is essentially a giant machine designed to bleed money through utility bills.
Precisely. And as global energy prices have remained highly volatile over the last few years, the economic calculus for a plant manager fundamentally shifts.
Because the payback period for ripping out an old, inefficient, heat-bleeding compressor and replacing it with a state-of-the-art, hyper-efficient Ingersoll Rand system is shrinking rapidly.
Exactly. The new machine literally pays for itself through energy savings in a matter of months.
So the high volatile cost of industrial electricity is actually a massive demand driver for their equipment. It changes the purchase from a discretionary capital expense into an urgent operational necessity.
That's right. But Vicente also highlighted a second mechanical reason for the sudden July unblocking, and it involves the broader engineering ecosystem. He noted that some of the earlier delays were simply due to EPC capacity constraints.
EPC, that's engineering, procurement, and construction.
Yep.
These are the massive, specialized contracting firms like Bechtel or Fluor that are hired to actually design and build these complex industrial facilities.
Right. If a chemical company wants to build a new plant, they don't design the air separation unit themselves. They hire an EPC. And Vicente explained that the EPC ecosystem has been severely bottlenecked by a shortage of specialized engineering talent and project management capacity.
Wow.
The EPC firms literally did not have the personnel available to finalize the technical blueprints and procurement lists.
And obviously, if the EPC hasn't finished the blueprint, they can't submit the purchase order to Ingersoll Rand for the equipment.
Exactly. It was a structural pipeline clog. But Vicente noted that in July, they finally saw those EPC bottlenecks begin to free up.
The blueprints were finalized, the purchase orders were released, and a massive surge of pent-up demand flooded onto Ingersoll Rand's order book.
Yes.
But, securing a massive influx of orders in July is only half the battle. Wall Street doesn't just want orders, they demand profitable revenue.
Always.
And we just spent 20 minutes dissecting how the margins in the ITS segment got crushed in Q2. If they're going to hit the high end of their EPS guidance for the year, they have to mathematically prove that they can rapidly expand their profitability in the second half.
That was the exact skepticism voiced by Chris Snyder, an analyst from Morgan Stanley.
Good.
He pressed CFO Vic Kinney hard on this back half margin ramp.
Because the required sequential expansion off of the depressed Q2 base seemed incredibly aggressive.
Oh, absolutely.
Yeah.
So how did Vic Kinney mechanically justify this margin expansion? Because, hope is not a strategy.
Well, Kinney didn't rely on hope. He laid out a 3-part mechanical formula for why margins are structurally guaranteed to improve in Q3 and Q4.
Okay, let's scrutinize the formula. What is the first lever they are pulling?
The first lever is the delayed realization of pricing actions. In the business-to-business industrial world, pricing is not dynamic. You don't just change the sticker price on a shelf overnight like a grocery store.
Right, when inflation hits your supply chain, it takes time to negotiate new contracts, update long-term catalog pricing, and pass those cost increases onto your industrial customers.
There's an inherent lag in the system.
Exactly. Kinney noted that the aggressive pricing actions they took in the first half of the year to combat inflation will finally start materializing and flowing through the income statement in the second half.
So mechanically, the exact same compressor that shipped in March for X dollars will ship in September for X plus 5%, carrying a structurally higher margin profile on the exact same manufacturing cost base. I buy that. What is the second lever?
The second lever is the realization of productivity savings. Ingersoll Rand is famous for a continuous, highly disciplined operating system they call IRX. Throughout the first half of the year, they executed various complex productivity projects, optimizing their supply chain routing, aggressively negotiating direct material cost reductions from their vendors, restructuring localized manufacturing footprints.
But why didn't those savings show up in Q2?
Due to the nature of manufacturing accounting, the actual financial realization of those cost-saving actions typically follows the cost of goods sold, which naturally peaks during their seasonally higher volume fourth quarter.
So their factories are structurally running more efficiently and their raw materials are sourced at a lower cost, just as the absolute volume of production hits its maximum seasonal capacity.
Yes.
The operational leverage there is immense. Okay, and what is the third lever?
The third lever is the simplest and most mathematically certain one: the absence of a one-time pain. The profit margins in the second half of the year will not be weighed down by that massive $49 million management incentive true-up that artificially depressed the Q2 numbers.
The surprise utility bill has been paid. It won't happen again. When you stack those 3 distinct mechanical levers together, higher negotiated prices taking effect, Massive productivity savings hitting the bottom line at peak seasonal volume, and the total absence of a one-time $49 million accounting charge, the aggressive margin ramp suddenly shifts from a hopeful projection to a mathematical certainty.
Exactly. It is a highly engineered financial outcome.
Yeah.
And that underlying mechanical certainty is exactly why management felt so confident raising the revenue bar and explicitly pointing the market toward the absolute high end of their earnings range.
Which brings us to the final phase of our analysis, the bottom line. This is where we synthesize all of this complex technical, regional, and financial data into actionable takeaways for an investor.
Right. If you are holding the stock or looking at allocating capital to it, what are the underlying catalysts you need to understand?
Well, the first major takeaway is the sheer strategic discipline of their inorganic growth engine.
Yep.
Ingersoll Rand does not rely solely on organic demand. They are a serial acquirer of smaller, highly specialized niche industrial companies. But what makes them unique in the industrial landscape is their ruthless adherence to valuation discipline.
Let's examine the actual deals they just announced to see this discipline in action. They closed on an acquisition of a U.S.-based company called Lone Star Blowers.
Right. Lone Star Blowers adds roughly $50 million in annual revenue. In addition to that, they signed a definitive agreement to acquire an Italian manufacturer of highly engineered industrial filters called Filtri, which adds another $30 million in revenue.
In the world of corporate M&A, these are tiny deals.
Yeah, these are not massive, transformative mega mergers that make front-page news. These are small, highly strategic bolt-on acquisitions.
Yeah.
What is the mechanical strategy connecting a U.S. blower company and an Italian filter company?
The overarching strategy is aftermarket expansion and recurring revenue density. Both of these companies, while small, bring highly established service businesses, extensive rental equipment fleets, and entrenched replacement part networks in their localized markets.
So Ingersoll Rand is acquiring them not just to own their proprietary technology, but to immediately deepen their own recurring revenue streams.
Exactly. They are buying structural resilience.
And Vicente noted on the call that they currently have 11 more of these specific types of transactions under letters of intent or LOIs. They're operating a highly systematized acquisition machine.
But the most illuminating data point regarding their M&A strategy wasn't actually what they bought. It was what they aggressively refused to buy.
Yes. When an analyst asked Vicente about the broader M&A environment and whether target companies were getting too expensive, Vicente casually dropped a massive revelation.
He mentioned that they had recently evaluated a massive $1 billion acquisition target, and they walked away.
They killed $1 billion deal.
Just completely walked away.
And they killed it purely because the valuation was too high. In an era of corporate finance where CEOs are often obsessed with empire building, where they will pursue top-line growth at any cost just to boast about the sheer size of their conglomerate, having a management team with the discipline to walk away from $1 billion transaction because the return on invested capital math doesn't work is an incredibly rare green flag.
It really proves an absolute foundational commitment to creating actual shareholder value, rather than just building a bigger empire for the sake of ego.
And that ruthless focus on capital allocation brings us to one of the most remarkable and frankly bizarre disclosures in this entire earnings transcript. It is the hidden windfall. I call it the corporate couch cushion money.
This is a phenomenal story. We need to break down the mechanics of the ILC Dover transaction and the subsequent RWI recovery, because this involves a very esoteric but highly impactful corner of corporate finance.
Let's translate this for you listening. In a previous transaction, Ingersoll Rand acquired a company called ILC Dover. And as part of that massive acquisition, they purchased something called RWI representations and warranties insurance. What exactly is the mechanism of RWI?
Well, when a massive corporation acquires another company, the seller is legally required to make extensive representations and warranties about the fundamental state of their business. They sign legal documents stating, our audited financials are strictly accurate. We do not have any hidden pending environmental lawsuits. Our core customer contracts are valid and enforceable, and so on.
Basically, they swear under legal penalty that they are not selling a lemon.
Exactly. Historically, buyers would require the seller to leave a massive chunk of the purchase price in an escrow account for several years, just in case one of those representations turned out to be a lie.
But escrow ties up capital.
Right, so the insurance industry created RWI. It is a specialized insurance policy the buyer takes out to protect themselves. If it turns out the seller was lying or completely wrong about the foundational state of the business, the buyer doesn't have to sue the seller and fight for years in court. They just file a claim with the insurance syndicate.
So apparently there was a massive foundational issue with the ILC Dover transaction that triggered this exact insurance policy. The seller's representations were flawed. Ingersoll Rand filed a massive claim last year.
Yeah.
And on this Q2 call, CFO Vic Kinney casually announced that they have reached a definitive agreement on an initial $187.5 million recovery from the insurance syndicates.
$187.5 million in pure cash.
That is a staggering amount of money to suddenly materialize on a balance sheet out of thin air.
It is massive. Kinney detailed the cash flow mechanics.
Yeah.
They already collected the first $25 million during Q2, which artificially boosted that massive free cash flow number we discussed earlier. And they expect to collect the remaining $162.5 million in the second half of this year.
And remarkably, he stated they are actively pursuing additional meaningful recoveries beyond this initial amount.
It's wild.
This is an incredible catalyst. But wait, I have a very cynical question about how management is treating this money.
Go for it.
If I am a CEO and my margins in China are getting squeezed, and I have an accounting true-up hurting my Q2 profitability, I am incredibly tempted to take this $187 million insurance payout, run it through the income statement, and use it to artificially inflate my adjusted earnings per share.
It would make you look like an absolute operational genius to Wall Street.
Exactly. Are they doing that? Are they hiding the bad news behind the insurance check?
They are absolutely not doing that, and it is a massive testament to their focus on what analysts call the quality of earnings. Vic Kinney explicitly stated on the call that they are entirely excluding this massive RWI recovery from their adjusted earnings metrics. Furthermore, the future cash collections are completely excluded from their free cash flow guidance.
Wow. So by actively excluding a massive influx of cash from their adjusted metrics, they are purposely making their headline numbers look lower than they actually are.
Yep. They are telling Wall Street, judge our operational health entirely on how many physical compressors and pumps we sell, not on how aggressive our corporate lawyers are at extracting settlements from insurance syndicates.
It is a profound demonstration of transparency. But here is the critical takeaway for an investor. While the payout is excluded from the operating metrics, that $187.5 million in cash is very, very real. It is sitting in their bank account.
Right. Kinney described it on the call as pure upside that directly strengthens our capital allocation firepower.
Which means they have nearly $200 million of pure unallocated surprise cash to go execute more of those highly strategic bolt-on M&A deals, or to aggressively buy back their own stock, or to increase their dividend.
It is a massive hidden catalyst sitting right there on the balance sheet, completely disconnected from the macroeconomic headwinds in China or Europe.
It provides them with an immense position of strength and optionality. Speaking of optionality, let's connect all of this foundational industrial execution to the biggest macroeconomic trend on the planet.
The AI boom.
Yeah. I know listeners are probably thinking, how on earth does an industrial vacuum company connect to the explosive growth of artificial intelligence and ChatGPT? We hinted at it earlier with the energy efficiency piece, but let's dive deep into the AI infrastructure play.
Analyst Andrew Buscaglia from BNP Paribas specifically pressed management on this exact connection during the Q&A. And Vicente Reynaud's answer illuminated a massive, wildly underappreciated reality of the digital age.
Which is?
Well, we have been conditioned to think of the cloud, software, and artificial intelligence as ethereal, weightless concepts.
Right, we think of code just floating in the ether.
But artificial intelligence is intensely, heavily physical. It requires the construction of massive hyperscale data centers, giant, windowless concrete warehouses filled with tens of thousands of incredibly dense, hyper-powerful computer servers running constantly.
And the physical byproduct of all that localized computing power is heat. Massive amounts of thermal energy.
Exactly. Historically, data centers were cooled by massive industrial air conditioning units, HVAC systems blowing cold air down the aisles. But the next generation AI chips, the massive GPUs from companies like NVIDIA, run so incredibly hot that traditional air cooling physics literally cannot keep up. Air is an insulator. It is a terrible conductor of heat.
You literally can't blow enough cold air fast enough to stop the chips from melting.
Precisely. So the entire architecture of hyperscale data centers is rapidly transitioning to liquid cooling. They are building massive, highly complex closed-loop systems that pump millions of gallons of engineered fluid or water directly to the server racks.
Or even immersing the servers directly in dielectric fluid, because liquid is an exponentially better thermal conductor.
Yeah. And how do you physically move millions of gallons of liquid through a server farm continuously with absolute microscopic precision, ensuring the pressure never drops and the system never leaks onto $1 billion worth of computing hardware?
You need the most highly engineered, utterly fail-proof, mission-critical pumps on Earth.
This is exactly where Ingersoll Rand's precision fluid technologies intersect with the AI boom. Vicente explicitly noted on the call that their highly specialized pumps are currently being designed into and used to move water in these exact closed-loop data center liquid cooling systems.
Their pumps are literally the physical circulatory system preventing the AI revolution from overheating. But the infrastructure play doesn't stop at the walls of the data center.
No, it doesn't.
The AI boom requires insane amounts of raw electricity. The existing power grids in the United States and Europe literally cannot handle the projected load.
We're witnessing a massive, urgent resurgence in the need to build new baseload power generation facilities. Tech giants are funding the construction of massive new natural gas power plants strictly to feed their localized AI data centers.
And power generation requires heavy, traditional industrial equipment. You cannot build or operate a natural gas power plant without massive arrays of industrial air compressors.
But Vicente highlighted a highly specific, fascinating niche within this power generation build-out. As massive amounts of new natural gas capacity are brought online, that gas must be odorized.
Odorized, because raw natural gas is completely odorless.
Exactly. It is odorless and highly explosive. For fundamental safety, so that a leak can be detected by the human nose before a facility detonates, a chemical called mercaptan, which smells like rotten eggs, must be continuously and precisely injected into the natural gas pipeline.
And how do you inject a highly toxic chemical into a high-pressure natural gas pipeline continuously and safely?
You use highly specialized, hermetically sealed chemical injection pumps. And Vicente stated on the call that through their PST segment, Ingersoll Rand is the absolute market leader in natural gas odorization technology.
So from the microscopic precision required to pump liquid coolant directly to the AI microchips to the massive industrial systems required to odorize the natural gas feeding the power plants that run those chips, Ingersoll Rand's boring physical equipment is deeply woven into the structural expansion of the AI economy.
It is the absolute definition of a pick and shovel play. You do not have to guess which specific software company or AI startup is going to win the algorithmic arms race. You can simply invest in the company manufacturing the physical plumbing that makes the entire digital ecosystem possible.
When you synthesize all of this, the complex segment data, the strategic aftermarket patience in China, the massive RWI windfall, and the deeply entrenched AI infrastructure tailwinds, you arrive at a very distinct opinionated verdict on this quarter. If I'm looking at this X-ray, what is the ultimate diagnosis?
The diagnosis is that this is a fundamentally bullish setup, completely disguised by transient localized noise. If an investor only reads the surface-level headlines, a margin squeeze in Asia, a $49 million accounting true-up, and delayed megaprojects in Europe, they might falsely conclude that the business is stumbling.
But when you drill down into the structural mechanics, the thesis is incredibly robust. Management confidently raised their full-year revenue guidance. The European delays proved to be entirely temporary, violently unblocking and driving double-digit order growth in July.
And they are operating with a fortress balance sheet, boasting $3.8 billion in liquidity, further amplified by a nearly $200 million surprise insurance payout that they are transparently excluding from their adjusted earnings.
They are executing a highly disciplined, valuation-sensitive M&A strategy that continuously expands their high-margin aftermarket reach.
And perhaps most importantly for the long-term investor, they are a compounding cash generation machine whose physical equipment is serving as the critical linchpin for the two most explosive growth vectors of the next decade: the global scale-up of biopharma manufacturing and the physical build-out of AI infrastructure.
So what does this all mean for you, the listener, trying to allocate capital in a complex market? We started this deep dive looking at a seemingly sluggish 2% organic order growth number. The initial X-ray looked a bit dull.
Yeah, it did.
But by breaking apart the segments and deeply exploring the physical and financial mechanics underneath, we have revealed a highly resilient, fiercely disciplined compounding engine. But before we wrap this up, we want to leave you with a final provocative thought. Something that wasn't explicitly debated on the earnings call, but is deeply structurally implied by the data we just analyzed.
We spent time exploring Vicente's striking thermodynamic statistic that compressed air accounts for roughly 30% of all industrial electricity consumption. As global energy grids become increasingly strain-driven heavily by the massive, unrelenting power demands of those AI data centers we just discussed. Baseload electricity prices are structurally guaranteed to remain highly volatile and likely increase significantly.
It is a fundamental law of supply and demand. You cannot add gigawatts of AI data center demand to an aging grid without driving up the cost of power for everyone else.
Exactly. So if you are a massive global manufacturer operating on tight margins and 30% of your skyrocketing power bill is generated just by running your legacy air compressors, upgrading to hyper-efficient next-generation equipment is no longer just a nice-to-have operational improvement.
It ceases to be a discretionary capital expense. It becomes an absolute financial imperative just to survive the utility bills.
So the provocative question for the next decade is this. Will boring industrial efficiency upgrades become the most urgent, yet completely overlooked, green energy transition play in the market?
Oh, that's interesting.
The investment world focuses obsessively on sexy technologies like solar panels, electric vehicles, and hydrogen fuel cells to solve the energy crisis. But what if the fastest, most economically viable way to immediately reduce the global industrial carbon footprint and relieve massive strain on the electrical grid is simply swapping out millions of inefficient, heat-bleeding industrial motors and compressors?
And if that mechanical reality takes hold, could a company like Ingersoll Rand eventually experience a massive structural valuation shift? Could Wall Street algorithms eventually stop valuing them as a traditional, cyclical, slow-growth industrial manufacturer and begin pricing them as a critical, high-multiple energy transition asset?
If their core product transitions in the eyes of the market from a simple capital expense to an immediate grid-relieving, energy-saving necessity, the entire investment thesis expands exponentially.
It is a paradigm shift that could completely re-rate the stock over the next 5 years. That is a mechanical reality to keep a very close eye on as the physical power demands of the AI revolution hit the limits of the traditional grid. Thank you for joining us on this deep dive. The next time you look at a corporate earnings report and the headline numbers seem murky, remember to look past the surface data. Drill into the cash conversion mechanics, understand the hidden catalysts driving the segments, and most importantly, keep questioning the X-rays.